Ever wondered why the stock market crashes seemingly out of nowhere? It's a common experience for investors and everyday people alike, where one moment the markets appear stable, and the next, they're plummeting. So what really causes these sudden downturns? Let's start with the basics. A stock market crash is generally defined as a rapid decline in stock prices. But why does this happen? One of the main culprits is panic selling. Imagine a crowded theater. If someone screams fire, chaos ensues, and people rush for the exits, often causing injury and confusion. In the stock market, when investors see prices dropping, fear can take over, prompting them to sell their stocks en masse. This panic can spread like wildfire. One investor sees a loss, then another, and before you know it, there's a stampede for the exit. Then there's economic data and news. Sometimes unexpected reports like rising unemployment rates or lower consumer spending can shake investor confidence. Think of it like a weather forecast. If a storm is brewing, people might start preparing for a rough time ahead. Similarly, bad news can lead investors to anticipate tougher conditions, causing them to sell off stocks to minimize losses. Another factor is speculation. Investors often try to predict future movements based on trends. If a lot of people think a stock is overpriced, they'll start selling, and that can trigger a downward spiral. It's like a game of dominoes. Once the first one falls, the rest follow quickly. So to sum it up, stock market crashes are typically driven by panic selling, negative economic news, and speculative actions. Understanding these mechanisms helps demystify why these events occur, making them a little less frightening. If you want to dive deeper into how these elements play out, stick around. Why does fear trigger a stock market crash? The heart of the matter lies in investor psychology. Imagine a crowded stadium during a tense game. If one fan panics and rushes for the exits, it creates a domino effect. One person's fear spreads, and soon, everyone is sprinting for safety. This is how fear operates in the stock market. When investors perceive uncertainty or danger, like a sudden economic downturn or geopolitical tensions, they often react emotionally rather than logically. Fear can turn a dip in stock prices into a steep plunge. Picture a boulder at the top of a hill. It starts rolling down slowly, but as it gains speed, it becomes harder to stop. The same goes for stock prices. A small downturn can trigger widespread panic selling, causing prices to accelerate downwards rapidly. This panic selling is compounded by the concept of herd mentality. Investors often look to others for cues about what to do. So when the first wave of panic sellers hits, others follow suit, fearing they'll miss the chance to exit the market safely. As more and more shares are sold, stock prices plummet, and the market experiences a crash. And here's the surprising part. This psychology can create a cycle. As prices drop, fear deepens, leading to even more selling, which further drives down prices. It's a vicious circle, where emotion overpowers rational decision-making. So understanding investor psychology is crucial to grasping why crashes happen. When fear runs rampant, it can turn a manageable market correction into a full-blown crash. That's why keeping a level head during turbulent times is vital, not just for individual investors, but for the market as a whole. Want to dive deeper into how to navigate these psychological waves? Hit that subscribe button for more insights. What do unemployment rates and inflation have to do with stock market crashes? A lot, actually. These economic indicators act like a dashboard for the economy, showing us how things are running. Imagine you're driving a car. If the fuel gauge drops too low or the check engine light comes on, you know something needs attention. Similarly, when key economic indicators flash warning signs, investors often respond by pulling back, which can lead to a market decline. Take unemployment rates, for example. If unemployment suddenly spikes, it means fewer people have jobs, and that typically translates to less money flowing into the economy. Picture a neighborhood where nearly everyone is out of work. No one is buying dinner at the local restaurant, and the restaurant owner starts worrying about paying rent. When consumer spending declines like this, businesses suffer, and so do their stock prices. And here's the surprising part. Investors don't just react to current unemployment rates. They anticipate what these numbers might mean for future corporate earnings. If they think rising unemployment will hurt profits, they might start selling off stocks now, fearing a downturn. This selling can create a snowball effect, where stock prices tumble even further, as more investors panic and join the sell-off. Inflation plays a similar role. When inflation rises, purchasing power declines. Consumers can buy less with the same amount of money, which can hurt businesses and lead to lower sales. If investors see these trends, they might become increasingly wary, contributing to a market decline. So the next time you hear about rising unemployment or inflation, remember, it's not just numbers on a screen. They're signals that can trigger significant shifts in investor behavior and ultimately the stock market itself. Understanding these indicators helps clarify why market crashes happen. For a deeper dive into these dynamics, consider subscribing for future insights. What happens when external events shake up the stock market? It's a question that often puzzles investors. Picture this: you're sitting in a cafe enjoying your coffee, when suddenly, the news flashes that a war has broken out in a key region of the world. Instantly, the atmosphere shifts and the markets react. Here's the surprising part: these unexpected events can create a wave of uncertainty. Investors, anxious about the implications of geopolitical tensions, may feel like they're on shaky ground. Just like a crowd quickly disperses when a fire alarm goes off, investors may rush to sell their stocks to avoid potential losses from a market downturn. Think of it this way: the stock market is like a giant interconnected web. When something happens in one part of the world, vibrations travel through that web, affecting all the threads. For example, if a natural disaster strikes a major production area, it can disrupt supply chains. Companies may struggle to deliver goods, potentially lowering their profits. As news spreads, investors begin to worry about the future earnings of these companies, prompting them to sell their shares. This isn't just about fear, it's about the unpredictability of human behavior. Investors often react not just to facts, but to fear of the unknown. When they lack confidence, they sell first and ask questions later, which can exacerbate market declines. A single event can trigger a chain reaction, leading to a crash that might seem illogical in calmer times. So as we've seen, external events can dramatically influence market behavior by introducing uncertainty and fear. Understanding this helps clarify why the stock market can react so violently to news that might not seem directly related to company performance. What happens when the stock market dips and suddenly you're forced to sell because you borrowed money to invest? This is where margin calls enter the scene. Imagine you want to buy a shiny new car, but you don't have the cash. So you take out a loan, adding a little risk to your purchase. Now if that car's value drops significantly, the lender might say, hey, you need to pay up or sell the car to protect their investment. This is similar to what happens in the stock market when investors use margin trading. When you trade on margin, you're essentially borrowing money from your broker to buy more shares than you could with your own cash. It's a way to amplify potential gains, but it also magnifies potential losses. If the stocks you bought with borrowed money start to lose value, your broker might issue a margin call, demanding that you deposit more funds to maintain your position. Here's the kicker: if you can't meet that margin call, your broker will start selling off your shares to cover the losses. This creates a domino effect. More selling leads to further declines in stock prices, which may trigger even more margin calls for other investors. It's like a heavy weight pulling down on an already sinking ship. So while outside events like economic news can shake the market, the mechanics of margin calls can turn a regular dip into a full-blown crash by forcing more selling. This vicious cycle can cause a rapid decline, leaving many investors scrambling. Understanding this dynamic of margin trading and margin calls can help demystify why market crashes often feel like they come out of nowhere. They don't just happen. They're often fueled by a series of cascading decisions, driven by fear and liquidity constraints. Curious about how these mechanisms play out in real time? Stay tuned for our final scene, where we tie everything together. So, why do stock market crashes happen? Imagine a crowded movie theater. Everyone's enjoying the film until someone yells fire. Panic spreads like wildfire. In the stock market, that panic can be triggered by a mix of psychology, economic signals, external shocks, and trading mechanics. Markets are driven by the emotions of their participants, fear and greed. When investors feel optimistic, they buy stocks, driving prices up. But when fear takes hold, they rush to sell, often leading to a rapid decline in prices. This herd mentality is a powerful force. It's the same reason why a small rumor can snowball into a massive sell-off. Then, we have economic signals. Think of these as the movie reviews before the film hits theaters. Economic indicators like unemployment rates, inflation, and GDP growth provide clues about the overall health of the economy. If these signals turn negative, say a sudden rise in unemployment, investors may interpret it as a bad sign and start to pull back, triggering a crash. Now consider external shocks. Events like geopolitical tensions, natural disasters, or even a pandemic can disrupt markets. They're the unexpected plot twists that nobody saw coming. When something like this happens, confidence erodes, and selling pressure mounts. Lastly, trading mechanics like margin calls play a crucial role. When prices drop, those who borrowed money to invest are forced to sell their positions to cover their losses, adding more downward pressure. It's a vicious cycle. By understanding these factors, psychology, economic signals, external shocks, and trading mechanics, you gain a clearer view of why crashes occur and how complex market behavior really is. If you found this insightful, consider subscribing for more market explanations.